Preparing for a finance manager at Lumen interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about your finance experience and why you want to join Lumen as a finance manager. I have built my career across FP&A, management reporting, forecasting, and business partnering, with increasing responsibility for decision support and team leadership. In my current role, I manage the annual plan, monthly outlook, and variance reviews for a large operating group. Lumen interests me because finance can directly influence network investment, customer economics, and transformation priorities. I would bring analytical rigor, clear communication, and a practical approach to turning financial information into better operating decisions. While answering, focus on your progression, scope of budgeting and forecasting, leadership experience, partnership with operations, and why Lumen's connectivity, transformation, and disciplined cost management agenda genuinely interest you. Question 2. How would you build an annual budget for a telecommunications business like Lumen? I would start with strategic priorities and establish an integrated driver-based model. Revenue would reflect customers, products, pricing, usage, churn, and sales pipeline conversion. Costs would incorporate network capacity, labor, vendors, service obligations, and productivity initiatives. I would separately model capital expenditure, depreciation, working capital, and cash flow, then challenge assumptions with operating leaders. Finally, I would present base, upside, and downside cases, assigning owners to each driver and documenting the assumptions for monthly performance tracking. Make sure to cover revenue drivers, customer volumes, pricing, churn, network costs, headcount, capital expenditure, working capital, business owner accountability, scenario analysis, and reconciliation to strategic and cash flow objectives. Question 3. Walk me through how you would analyze a monthly variance to budget. I first reconcile actual results to the approved budget and prior forecast, then decompose the variance into volume, price, mix, timing, rate, and unusual items. For example, a revenue shortfall may reflect lower customer connections, while an expense favorability could simply be delayed hiring. I validate the explanation against operational data and speak with the responsible leader. The final commentary should explain the cause, quantify the full-year impact, update the forecast, and identify a specific action or decision. In your answer, talk about separating price, volume, mix, timing, rate, and one-time effects, validating data, identifying root causes, quantifying outlook impact, and agreeing corrective actions with accountable business partners. Question 4. What is the difference between forecasting and budgeting, and how do you use both? A budget is the formally approved financial plan and performance baseline for a period. A forecast is management's current best estimate of what will happen, incorporating actual results and changed assumptions. I use the budget to measure accountability and allocate resources, while using rolling forecasts to support decisions before results are locked in. If performance changes materially, I update the forecast rather than silently altering the budget, so leaders can distinguish execution variance from changes in the external environment. Be sure to mention that budgets establish targets and resource commitments, forecasts provide updated expectations, and both require consistent drivers, governance, variance analysis, and clear communication about performance versus plan. Question 5. How would you forecast revenue for Lumen's enterprise connectivity and networking services? I would combine contracted revenue with a driver-based view of new and existing customers. The model would track bookings, backlog, installation timing, renewals, churn, price changes, product mix, and expected pipeline conversion. I would segment the analysis by customer type and service, because enterprise connectivity behaves differently from usage-based offerings. I would also reconcile sales forecasts to billing and revenue recognition data, then stress test assumptions around timing, cancellations, and competitive pricing before presenting the outlook. Focus on customer cohorts, contracted revenue, bookings, pipeline conversion, renewals, churn, pricing, product mix, installation timing, usage trends, and reconciliation between sales assumptions and finances independent view. Question 6. How do you evaluate whether a cost-saving initiative is genuinely delivering value? I establish a clear baseline before implementation, normalize for volume and business changes, and define whether the target is cost reduction, cost avoidance, or productivity. I then track actual spend against that baseline, separating timing benefits from recurring run rate savings. For example, reducing vendor charges is only sustainable if contract terms and service levels support it. I would report implementation costs, net benefits, and operational impacts, with an accountable owner and monthly validation through the close process. While answering, cover a documented baseline, normalized run rate, implementation costs, timing, avoidance versus realized savings, service quality effects, ownership, and controls preventing the benefit from being reversed. Question 7. Describe your approach to managing a complex month-end close. I begin with a detailed close calendar that assigns owners, deadlines, dependencies, and review controls. Key areas include revenue cutoff, vendor accruals, payroll, fixed assets, intercompany balances, and account reconciliations. I use materiality thresholds to prioritize review while investigating unusual movements through trend and variance analysis. During close, I maintain an issues log and escalate blockers early. After finalizing results, I perform a quality review and capture process improvements for the next cycle, especially opportunities for automation. Mention a close calendar, materiality thresholds, reconciliations, accruals, intercompany controls, review responsibilities, issue escalation, automation, and timely management reporting without compromising accuracy. Question 8. How would you ensure accurate revenue recognition in a telecommunications environment? I would begin by understanding the contract terms and identifying each performance obligation, such as connectivity, equipment, installation, or support. The accounting treatment should reflect when control or service delivery occurs, with transaction price allocated appropriately across obligations. Operational evidence, billing interfaces, and cutoff controls are essential because invoicing does not always equal recognized revenue. I would partner with accounting policy, legal, sales, and systems teams, document judgments, and monitor contract modifications, credits, and estimated variable consideration. In your answer, talk about contract terms, performance obligations, distinct services, transaction price, allocation, delivery evidence, billing interfaces, cutoff, estimates, and coordination among accounting, sales, legal, and systems teams. Question 9. Tell me about a time you improved a finance process. In one role, monthly forecast consolidation required multiple spreadsheets and created frequent version errors. I mapped the process, identified duplicated inputs, and worked with business owners to standardize definitions and submission deadlines. We moved recurring calculations into a controlled reporting tool and added validation checks before consolidation. The cycle shortened by 2 days, review time fell materially, and forecast commentary became more consistent. I also documented ownership and trained users, because sustainable process improvement requires governance, not just a new template. Be sure to structure the example with the original problem, root cause, stakeholders, redesigned process, technology or control improvements, measurable results, and how you ensured adoption after implementation. Question 10. How do you analyze a capital expenditure request for network infrastructure? I would assess the request from both strategic and financial perspectives. First, I would confirm the capacity or customer need, timing, technical scope, and alternatives. Then I would model incremental revenue, avoided operating costs, maintenance, depreciation, taxes, working capital, and cash timing. I would calculate relevant returns such as payback and NPV, while testing demand, construction delays, and cost overruns. After approval, I would compare actual spending and benefits with the original case, feeding lessons into future capital decisions. Focus on strategic need, capacity, customer demand, expected revenue, operating savings, cash timing, useful life, return metrics, risks, alternatives, post-investment tracking, and alignment with capital allocation priorities. Question 11. What financial metrics would you monitor for a telecom and networking business? I would monitor revenue growth, bookings, backlog, churn, renewal rates, customer acquisition cost, and revenue mix by product and customer segment. Profitability metrics would include gross margin, adjusted EBITDA, operating expense productivity, and contribution margin. Because connectivity is capital intensive, I would also track capital expenditure, free cash flow, working capital, and network utilization. The key is linking operating metrics to financial outcomes. A strong bookings number matters only if it converts into profitable, collectible revenue. Mention revenue growth, churn, bookings, backlog, customer acquisition cost, adjusted EBITDA, margin, cash flow, capital intensity, working capital, service levels, and metrics segmented by product and customer cohort. Question 12. How do you manage cash flow forecasting and working capital? I build cash forecasts from operational drivers rather than simply applying a percentage to earnings. The model includes collections by receivable aging, vendor payment timing, payroll, taxes, capital expenditure, debt service, and one-time items. I compare actual cash conversion with forecast and investigate timing differences separately from structural issues. I would also create downside scenarios, such as slower collections or delayed projects, and identify actions involving billing quality, dispute resolution, payment terms, and discretionary spending while protecting service continuity. In your answer, cover receipts, collections, payables, vendor terms, payroll, capital spending, taxes, debt service, seasonality, forecast accuracy, liquidity scenarios, and actions that protect cash without harming customer or supplier relationships. Question 13. Describe a time you challenged a business partner's financial assumptions. A business leader once assumed a new service would reach full sales productivity within 6 months. I reviewed historical ramp curves, pipeline quality, capacity constraints, and pricing assumptions, then built a slower conversion scenario. Rather than rejecting the plan, I presented the evidence and suggested milestone-based hiring and spending. We agreed on a phased forecast with explicit triggers. That approach preserved the strategic opportunity while avoiding premature cost, and the operating team remained engaged because the challenge was constructive and transparent. Make sure to demonstrate respectful challenge, evidence-based analysis, independent judgment, scenario modeling, understanding of commercial context, collaborative resolution, and willingness to escalate only when material risk remains. Question 14. How would you explain disappointing financial results to a non-finance executive? I would lead with the headline, quantify the gap, and explain the business drivers in plain language. For example, I might say revenue was $4 million below plan because 2 large installations moved into the next quarter, while margin also suffered from temporary subcontractor costs. I would distinguish timing from permanent loss, identify what management can control, and recommend actions. I would then explain the forecast implication, risks, and decision required, avoiding excessive accounting terminology. Focus on a concise business narrative, material drivers, operational evidence, financial impact, distinction between controllable and external factors, recommended actions, and implications for the forecast and strategic priorities. Question 15. How do you prioritize competing deadlines during a busy close or planning cycle? I prioritize based on financial materiality, external or executive deadlines, process dependencies, and the consequences of delay. I create a visible task list, assign clear owners, and identify critical path activities early. Routine work can be delegated or standardized, while high-risk judgments receive focused review. If conflicts arise, I communicate the trade-off promptly and propose alternatives rather than simply missing a deadline. Throughout the cycle, I protect control quality, because speed without reliable information creates larger downstream problems. Be sure to mention materiality, regulatory and executive deadlines, dependencies, resource capacity, delegation, visible tracking, early escalation, quality thresholds, and communication when priorities or delivery dates must change. Question 16. What internal controls are most important in financial planning and reporting? Strong controls should ensure that data is complete, assumptions are authorized, and reporting can be reproduced. I would use role-based access, controlled templates, version management, reconciliations to the general ledger, documented review sign-offs, and clear approval thresholds. Manual journals need independent review, while forecast changes should retain an audit trail explaining who changed what and why. I also distinguish preventive from detective controls and test whether they operate effectively, not merely whether a policy exists. Discuss segregation of duties, approved assumptions, access controls, data reconciliations, version management, review evidence, journal controls, forecast governance, audit trails, and monitoring of management overrides. Question 17. How would you use data and automation to improve finance decision-making at Lumen? I would first improve data consistency and define common metrics across finance and operations. Once the foundation is reliable, recurring data pulls, reconciliations, and dashboard updates can be automated, allowing the team to focus on exceptions and decisions. For example, a driver-based dashboard could connect customer activity, bookings, billing, expenses, and cash outcomes. I would pilot the solution with users, document controls, and monitor adoption. Automation should reduce effort and error while keeping judgment and accountability with finance professionals. In your answer, cover reliable source data, standardized definitions, automated reporting, exception-based review, dashboard design, system integration, user adoption, data governance, and preserving human judgment for material decisions. Question 18. Tell me about a time you led or developed a finance team. I lead by setting clear outcomes, assigning ownership, and giving people enough context to make decisions independently. In a previous team, I paired experienced analysts with newer colleagues, introduced monthly development conversations, and rotated ownership of management reporting. I gave specific feedback after each cycle and recognized improvements publicly. The team became less dependent on one individual, reporting quality improved, and analysts developed stronger business partnering skills. My goal is a team that can deliver reliably while continuing to grow. Mention setting expectations, coaching, workload allocation, technical development, feedback, inclusion, succession planning, performance management, and measurable improvements in accuracy, timeliness, capability, or engagement. Question 19. Describe a time you found an error in financial reporting. What did you do? During a review, I identified a recurring expense accrual that had been overstated because a source file included inactive contracts. I first quantified the current period and year-to-date impact, preserved the evidence, and informed the controller rather than correcting it informally. We processed the appropriate adjustment, assessed whether prior reporting was affected, and traced the issue to weak master data controls. I then added an exception report and ownership review, preventing similar inactive contracts from entering future accrual calculations. While answering, emphasize containment, materiality assessment, root cause analysis, transparent escalation, correction through proper controls, stakeholder communication, and preventive actions that reduce the chance of recurrence. Question 20. What would your first 90 days as finance manager at Lumen look like? In the first 30 days, I would learn the business, meet operational and finance partners, understand strategic priorities, and review reporting, close, forecast, and control processes. By day 60, I would identify the largest performance drivers, recurring pain points, and immediate risks, validating them with stakeholders. By day 90, I would deliver one practical improvement, establish a clear performance cadence, and propose a roadmap for better forecasting, automation, and decision support. I would listen first, then act with evidence. Be sure to outline listening and relationship building, understanding strategy and key drivers, reviewing close and forecast processes, assessing risks, delivering an early improvement, and creating a practical longer-term finance roadmap. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.